Good evening, ladies and gentlemen. Okay then, so tonight's video, we're going to get straight to it. Inflation and recession. You are seeing these terms being thrown about because that's exactly what the story is right now. But the problem is, it's like everyone's behaving like as if recession and inflation is a new thing. I'm talking the powers that be. You're getting hedge funds talking about it being a perilous recession, or the worst is yet to come. We're going to see more blood on the streets. But ladies and gentlemen, human nature doesn't change. And all we need to do is we need to just bring a few factors just to put your attention into understanding why the business model of the markets will always be exactly the same. All right? So whilst Bitcoin makes a recovery back up to the upside, happy days, let's just dive into the S&P for a split second, just to help you understand the story of why inflation and recession is nothing new. Here we go. The S&P. Go onto the monthly time frame, ladies and gentlemen, and you will see that the S&P itself has seen moves up and moves down, fear and greed. But what we need to understand is the actual geopolitical events that have been happening during the S&P's move to the upside and their move to the downside. So we can start off firstly with the dot-com bubble of 2000. Prior to this, the market was actually seeing some fantastic economic expansion. Okay? The rate of interest around this time was around 6.5%. Everything was pretty decent. Interest was good. People were working, money was being made, credit was being provided, spending was cool. Until you had the dot-com burst, okay? You had around about this time as well, the US leading intervention into Kosovo. All right? Price drops. But if we look behind the scenes of it all, stocks were increasing in value. They were inflating up from 94 all the way up to 2000. So for 5 years, the stock market just moved up. At what point is anyone going to make any money? You see, the average investor is always going to be buying when it's at the highest point. This is why they call this zone the climatic zone, where you see a big influx of liquidity coming in on probably low volume in the eyes of the market. But the narrative shows that the markets are all trading positive today. Investors are sitting tight, thinking that any retracement is not going to last too long anyway. Then we see the complete drop to the downside. We then have the subprime mortgage crisis of 2007-2008, which was deemed as the biggest global financial crisis across the world. We had around about this time $700 billion Senate package, which was designed as a bailout for the US. We had Lehman Brothers bankruptcy. You had unemployment rate at 6.5%. Crude oil was at $100 a barrel. Housing bubble bursts. And the interest rate was declining and just being smacked out. They needed a reset. It needed to change because they were expanding from 2002 all the way up towards 2007. You see, the same credit policies that they had in the last 188 months up until that point, or should I say this point right here, they needed to change things. They needed to recuperate everything that they have just provided out. This is why the Fed's always printing money, ladies and gentlemen. People aren't able to make returns on the payments that they've been taking on credit. Inflation was increasing at this point as well. $100 a barrel of oil. There was a problem. Price then drops. Now we have this mad move to the upside. And we look at where we are right now in terms of inflation and recession. And we can correlate it to what has happened before and see that we're in exactly the same situation. We have a war in Ukraine. We have tariffs in China right now being put out. We have sanctions on Russia. We've got inflation. Oil trading at $110 a barrel. Obviously, now oil is trading right now at $99 a barrel. Happy days. Oil's going down. But we've got other factors that are coming into play. This is not the US recession. This is a global recession because we've got more than one country that is suffering from this. Look at what's going to happen now. Russia's set to switch off the gas for work on a key pipeline. This article goes into understanding that the Eurozone is quite concerned about this because the same pipeline that Russia is due to do for annual maintenance is the European Union's biggest piece of gas import infrastructure. So that's going to be a problem for the Eurozone because they don't think that it's going to come back on, given that the Russia, Putin, ain't doing too well with all nations across the world. He ain't got exactly many friends now, has he? Now you got Biden wanting to put sanctions and tariffs on China. There's no community. Yeah? Go back in time. Look at what had happened in the past and look at what's going on right now. So coupled with the idea of war in Ukraine, the idea of Russia cutting the actual gas line, we've got inflation. The Eurozone itself is very happy about, here we go, where's the article? It says it. ECB policymakers are wavering in support for a tighter monetary policy. Everyone's increasing their interest rates, squeezing the average Joe. My concern is, if oil is dropping now, okay, in relation to this article about Russia cutting the gas, then we're probably going to see oil start to climb back up. At what point are they going to engage back in dollar dominance? So what I'm trying to say to you guys is it's all psychological. Install the fear, install the fear. But how can we profit from this sort of situation? Well, we need to understand what triggers movement across the board. So let's just take the idea of Bitcoin for a split second, okay? Bitcoin right now is looking to come back up. We've had a bit of a retrace to the downside, and you can see right now that it's trying to work its way back up towards today's gains. From today's loss, they've actually recovered the whole range itself. This is good news for Bitcoin until they can break above the 20,492 zone. Because all they've done is come back into the recovery of the previous red vector candle. All they've done is come back into the same spot that they sold from. In other words, are they able to get the same amount of interest at this point again to sell off and come back into the recovery of the green vector candle? More importantly, ladies and gentlemen, we've got news coming out this week, which is going to be a little bit of a situation for the US. Going into the articles themselves, you can see that tomorrow we have the JOLTS job openings report, the ISM services PMI, and the meeting minutes from the Fed. Now, why are these three factors here very important? Well, let's just look at the logic. The job openings report last month came out that there were 11.5 million offers of jobs available for people. Yet, there's 5.9 million people in unemployment in the US. Why are they not going into work? So the Fed needs to do something about that. They need to reduce that area right there. They need to reduce that deficit without causing an employment recession, where there's loads of jobs out there, but no one's taking them, and the actual unemployment rate is high. You've got the ISM services, which is also another important reading for the markets. Why? Because this tells us, as a leading indicator of economic health, it tells us how businesses react quickly to market conditions, and their purchasing managers hold perhaps most current and relevant insight into the company's view of the economy. So think about it like this. If the Fed is getting very aggressive with their interest rates, that means the cost of doing business is going to increase. That means purchasing managers are going to scale back. They're going to reduce their orders overseas. That means that if they're going to reduce their orders, that means they're trying to retain cash. That could then be followed by lower estimates in their quarterly earnings. That could then be followed by cuts in employment. So you can see that it's a colossal effect, and it all starts off from the idea of inflation and recession. Now, once they declare that we are in full-scale recession, and it says it in black and white, and you read in the papers, recession is here, we're going to see a plethora of events happening across the board. If this reading of the ISM shows a reduction below 50, it tells us there is a contraction, then that means there is a problem in the US in relation to purchasing managers, and that tells us where they are as businesses. It just tells us where businesses are, which can then project out how likely companies in the stock market are going to be declaring positive expectations for their earnings or negative expectations. The Fed itself, with their meetings that are coming out tomorrow at 7 p.m., there's not going to be anything that we're not going to be aware of what they could be saying. But at the same time, if they do decide to say something outside of the norm of what they're expected to say, then that is going to ricochet the markets and send them into a mad move. It's tomorrow and Friday that determines what's going to happen with the Fed. We have the average hourly earnings coming out. We have the non-farm employment change and then the unemployment rate. This is going to show how bad the inflation and, of course, the idea of a pending recession is going to be. If the unemployment rate for the US is going up, that would then be justified by the JOLTS job opening saying that there are jobs out there, you're just not taking them, which is then more and more people being laid off because the fact that the Fed's increasing the interest rates means that cost of business is going to be higher. People with mortgages are going to see the squeeze with their payments having to be increased. You've got companies that have got loans that conduct business every day can see an increase in the repayments, which means that they're going to have less profit to do more things and even conduct business on everyday purposes. So you can see that it's all a domino effect. But what I'm trying to say to you guys is this is exactly the same situation that we were back in 2007, 2008, back in the dot-com bubble. It was exactly the same story. It's all psychological. Now, what we need to do is we need to accept that we are in recession. The sooner that the masses accept that that is the idea, the easier it's going to be for us to come to the charts and say, okay, what opportunities can I exploit? So let's just look at Bitcoin. Is Bitcoin factoring the idea of a recession? Through a war, rate hikes, sanctions, inflation, and psychologically in recession that is happening right now, Bitcoin has done very well to hold this 20K zone. Even the S&P itself is doing well to hold this range. Yeah? Oil right now is taking a nosedive. But that could be in anticipation for this close on the actual gas line, which could then see oil coming back up to recover the vector candles. So could they have manipulated oil purposely? The only way that you can resolve oil situation and the way you can control inflation, which was said by a billionaire oil baron, he said it. We have got over 100 years worth of oil supply. Flood the markets with as much oil as possible to just slam the price down. And that is how you control inflation. But they don't want to do that. So that leads to the next question. Is this been purposely done? Of course it is. Think about it. Put your comments in the comments section. What do you think? Do you think this play by oil today has only been set up with the anticipation of Russia cutting the gas pipeline? Again, commodities. Traders run to commodities in times of fear. If they've dropped oil in relation to the job openings reports and the ISM and of course the Fed's FOMC minutes reading, are they going to rush to oil when that information comes out? Look at dollar yen. Hasn't done much today, has it? It's just simply traded up, down, continuation to the upside is what the narrative says. Look at gold, taking a nosedive. Dollar dominance. You see, a higher value dollar isn't good for the dollar. As much as the dollar dominance is something that everyone favors, a high value dollar is not good for business. And Donald Trump said that, and that's what he was trying to get. He was trying to get that to happen. But no, dollar dominance is high. Just look at it. Dollar index. 6% appreciation on the dollar, ladies and gentlemen. That's going to be a problem for the dollar. We are waiting for it to come back down. But we just need to know exactly how aggressive is the Fed going to be. Because the second they show aggressive nature and rates need to be above the 0 point that they said, as Mr. Williams said, until that time happens, we're going to still see the same thing. Recession, inflation, and how bad it is. Now, for those of you who are new to the idea of investing and trading, you have to understand what's going on in the markets. It's recession. That's all the psychological impact. But there are two things that happen in marketplaces. That's markup and markdown phases. Okay? Just take the idea of the S&P itself, zoom out and understand where you are. Look, the S&P itself has moved up and it's retraced. They've made their money, now they're cashing out. They've made their money, cashing out and loading up again. This drop to the downside with the S&P's testing the 50 EMA. They're talking about a bigger drop down, even though 24% reduction on assets across the board is all good. And it's actually, I understand why they say that the S&P could drop down even further, because you can appreciate a 600% increase in the S&P itself. tells you that there are a lot of inflated assets out there that need to be deflated, because we know that when something is inflated, it has to deflate, and when something is too deflated, it will then eventually inflate. What's the one strategy that we always focus on? Retrace to the 50 EMA. Deviation away from it, retrace back into it. They're talking of an S&P ending up at 6,000. Once this move, and once we've fully factored the idea of recession and inflation, and everyone is just completely battered from the idea of what's going on economically, the next bull run up will be a very interesting one. It would then have to be bigger than the economic expansion from March 09 all the way up to May 22. So, ladies and gentlemen, I hope that puts things into perspective for you. Coming away from a lot of price action that I normally get into, guys, but I just wanted to put things into perspective for you. Human nature doesn't change, guys. The same way Bitcoin goes up, it's the same way it comes back down. Bitcoin, if it keeps on going down lower, fine, we can accept that. Will Bitcoin collapse? No. It's been collapsing since 67, 69, sorry. Okay? That's a fair collapse. That is a complete drop. Guys are talking about Bitcoin needing to retrace 87%. So from this point up here, all the way down to this zone, we are now at 74%. So we still got a little bit of a move in Bitcoin. To fully accept that, statistically, Bitcoin needs to go beyond the 84% or be at 84% for us to believe it's going to come back up. Well, we then correlate that into the chart itself and understand that where does that 84% area reside at? Okay, so just watch this. If I take this point, if I take this point from the high, going all the way to the vector candle point, we would then see a full recovery of those vectors would lead us to an 80% correction in Bitcoin. If we really mean it and we go down to this vector candle point right here, that would then lead us into the 91 zone. So that's that 84% they're expecting and a little bit more. Is it possible? Most definitely. Will it be sustained? I don't think it will be sustained. If you can move an asset from this price point all the way up to 69K and you can bring it back down again, you can definitely bring it back up. Okay? Mad love and respect, ladies and gentlemen. I hope tonight has put things into perspective for you. Be sure to like and subscribe so that we can check in tomorrow to bring that New York fire. Have yourselves a wonderful evening, guys. Take care of yourselves, and I'll speak to you tomorrow. Peace.